Welcome to Finance Deep Dive. Inflation, recession, GDP. You've heard these words thrown around on the news all the time, right? Well, in this video, we're going to cut through all the jargon and connect the dots between them. And we're going to do it fast.
All right, let's kick things off with inflation, because let's be real, this is the one that's like a silent force directly messing with the money in your wallet.
So what's the deal here? It's that classic economic pinch. You look around, and prices for pretty much everything are climbing. And suddenly, every single dollar you have buys a little bit less than it did before.
Think about it like this, okay? Last year, going to the movies cost you $10. This year, that same ticket is $12. That extra $2 for the exact same experience? Yep, that's inflation in action.
Now, you might be thinking, is all inflation bad? Well, not exactly. A little bit of it is actually seen as normal, a sign that the economy is growing. But when it gets really high, that's when it gets dangerous and can seriously hurt your finances. And here's the bottom line, the thing you really got to remember. If your savings aren't growing faster than inflation, you're actually losing buying power. Your money is worth less and less each day.
So, when inflation gets way too high, the big banks might step in to cool things down, which, believe it or not, can sometimes lead us straight into our next big topic, a recession.
So what is a recession, really? Put simply, it's when the whole economy just shrinks. And we're not talking about a bad week, we're talking about a significant decline that lasts for months.
And what does a shrinking economy actually feel like? Well, it creates this nasty domino effect. Businesses slow down, which leads to people losing their jobs. Then, with less money, people spend less, which, you guessed it, causes businesses to slow down even more.
If you want a powerful, real-world example of this, just think back to the 2008 financial crisis. That was a huge recession, and people felt the effects for years afterward.
Ultimately, when you boil it all down, a recession just means the flow of money in the economy has slowed way down.
You know, a great analogy is that the economy is catching a cold. It gets all sluggish and weak. And yeah, it'll probably recover. But that recovery can be a really long and painful process for a lot of people.
Okay, so we've talked about the economy shrinking or growing. But how do we actually know which one it's doing? How do we measure all this? Well, that's where our final term comes in, GDP.
GDP. It stands for Gross Domestic Product. And basically, it's just the final price tag on everything a country makes and does in a year. All the goods, all the services, the whole shebang. And this number counts everything, right? From the cars we build, those are the goods, to the software we use and the coffee we buy, those are the services. So using our simple example here, you just add the value of those goods and services together to get a total GDP of, in this case, a whopping $1.2 trillion.
But here's what the experts really watch. It's not the total number, it's how fast it's changing. Positive GDP growth, that's a sign of a strong economy. But 2/4 of it going down, that's the official alarm bell for a recession.
So really, you can think of GDP as a country's economic report card. It gives you a quick snapshot that tells you, at a glance, how things are going.
And that's how it all connects. Hey, if you are liking the content in this video, please don't forget to subscribe. It really motivates us to keep posting.